What's shaking? Hey, I'm Rick Jordan, and today we're going all in. Man, I'm hoping that you can help out because I'm thinking like you've been an investment planner for 40 years, right?
Right.
Yeah, the retirement income coach, Steve Selengut. Did I pronounce your name correctly? Did I get that?
Yeah, you did. You did. You got
you're pretty good
try.
at that.
First try.
Good, my man. It's awesome to have you because I think back when I was because I'm 45 now, right? And it's, income levels and everything look very different today than they did back when I was 25. You know, we'll just put it that way, which is a good thing, right? Everybody wants to move forward in life.
You should have seen it when I was 25.
Yeah, tell me about that. Seriously, for real.
Well, my first job when I got out of college was with a big insurance company in New York, and my starting salary was $4,200 a year.
Wow.
Can you imagine? And
That's incredible.
And I had a commute to New York.
Oh man, that's brilliant. Yeah. So when I was in my 20s though, for real, because it's, I know things are a little different, and I love how I'm planning for my 60s, 70s, 80s, and hopefully 90s, where I'm at today, because I've got a great spread of investments and a universal life portfolio, an index universal life. So it's definitely indexed from a compounding interest perspective, and it's just phenomenal. Now, when I take a look back, it's like I take a look and I know exactly what my expenses are going to be when I turn 65, and I know exactly what I'll be able to cover those expenses with, and everything beyond that is great. So but also, of course, I like generational wealth, which is why I do what I do. But man, when I was 25, I thought retirement planning was a 401k and Social Security. Like literally that's all.
Right. Well, most of the people that I see, many of them are really relying on what's in their 401k, and of course, you can't really run a 401k unless it's a private one to generate income. And of course, that's what my expertise is getting that income. So the only thing you can
hold on right there, because you mentioned something, and I want you to differentiate this for everybody who's listening. It's important because you mentioned a private 401k. So you are not talking one that is provided by your company or matched by your company, right? Your employer?
Well, no. I most of them, where the employers, you can't touch it. But there are some employers who I had as clients when I was managing other people's money who had internal 401ks that they could put to any investment advisor they want. So, for example, this was like there were 6 people, I think, in this business, and the executives and a couple of assistants and so on. So I managed a separate portfolio for each of them within their 401k.
Okay.
So they could have all the trading, all the individual securities, all the income generation and everything. That was the only 401k I managed.
I got you.
That was like a private 401k. It was a private company that had their own 401k.
I got you. Okay, so they had their own portfolio that was just within that company, is what you're saying. Okay.
Right, and they were all each portfolio was different.
Yeah, right on it is. Absolutely.
Yeah.
I've seen scenarios like that too, but if you're talking to a 25-year-old today, man, what do you tell them? Because I'm guessing that your typical clientele is not necessarily in their 20s.
No.
Right?
Not too many at all. In fact,
but don't you wish it was though?
A coaching client in their 20s. But
don't you wish it was? Seriously.
I wish well, yes. I would like if I could reach people in their 20s like I started investing when I was 25.
Yeah.
There weren't even IRAs back then.
Yeah, I'm with you.
At my employer, the one I mentioned, we had what was called a savings and investment plan. And it was a match. It was, they matched, you could put in a certain percent and they matched it just like these other ones now. But you only had 2 choices. You could specify whether you wanted to be in the stock market or if you wanted income investments.
Okay.
Those were the 2 things. And that was pretty cool because, when I was there a couple of years before I started before I got some money and actually I didn't get money. I got a whole the whole package of securities to start with, and that's when I really started in the investing, and that's when I started to be employed with the pension investment department. So I was getting an investment education from my employer as well as from my own experience at that time. But the plan that I had itself, that's were the only two choices you wanted. So, I mean, it was pretty obvious. It was obvious to me, maybe not to many people, but if you knew the stock market was at a very high level, you could, you had 2 or 3 times a year where you could transfer from equity to income. I used to transfer from some of my equity to income when the market was very, very high. And then if we had a market going down a little bit, then I'd move it back from the income side to the equity side.
Yeah.
So that's about all you can really do in a 401k is look at the market cycle where you are and take advantage of it in that way by how you organize the investments that are already there. You can't really pick. You can, well, in most of them you can pick types of investments as well. And if you can figure out what all the verbiage means, whether it favors income investing or equity investing, then you can make similar choices.
Yeah, I'm tracking with you.
I don't see that most people do that. I
don't think most even understand that, and that's the point. So it's if I
most of the 401ks I see are all stock market.
Yeah, let's take 2 different crowds here because I want to focus hardcore on these 20-year-olds.
Okay.
Seriously, let's take 2 crowds. One would be the W-2 employees, right? You get a paycheck, you work for a company, all of that, and the other would be entrepreneurs. So let's start with the W-2 paycheck people, who are listening. If they're in their 20s, what should they be doing today to make sure that they're great 40 years from now?
Well, they got to start setting aside money that, they don't just spend, every time they get a bonus or something, they can't just throw it into a better car.
Yeah. Are you talking just as simple as a savings account? Because, those don't have very high yields, of course.
No, you don't have to use a savings account in a bank. There are securities you can use.
Bitcoin, right?
No, I'm not talking. That's one of the biggest mistakes people make is they have only a little bit to invest. I used to see it back in the day when your initial IRA investment was $1,500. I'd get clients who had been 4 years in an IRA and all they had was the last $1,500 they put in because they speculated with every one. And they never put it to work. There are 2 times that you have to be really careful in investing. When you're very, very young and you want to get it started, and when you're my age and you don't want to lose it because you're going to depend on the income it produces. Okay.
So let's say a 20-year-old, 25-year-old is making, we'll say $80,000 a year, which is pretty common. Yeah, it wasn't that way 20 years ago, right? But that's a pretty common livable wage today.
Yeah,
when you're in that age, we'll say $80,000 a year. I know because I have technicians working for my company that are in their 20s, and that's what they're getting paid. So they're making $80,000 a year. Let's just say that they have about 20% disposable income.
Okay.
What should they do with it?
They should determine what amount let's say they could figure out a way to invest $10,000 a year.
Okay.
Or even $8,000. It really doesn't matter. What matters is to put it. There's 4 ways to minimize risk: quality, diversification, income, and profit taking. So the first 3 are important right away. So they have to find a form of investment that's relatively safe, diversified, and producing income. And the perfect thing my idea of the perfect thing, what I would do, what I did for my kids, and what I encourage my coaching clients to do for their children and grandchildren, are these things called closed-end funds, which are similar to ETFs and mutual funds, which they're all familiar with, except they're trust vehicles, and their real purpose is to generate income, not to grow in market value. If you keep reinvesting your income every year, your market value is going to take care of itself. It's going to grow.
Yeah.
and it will be producing income. So eventually you get to the stage where I was when I was 29, where your income from your investing is more than you're making from your employer. That's what you want to look forward to.
That's what people are looking for
and
real.
The sooner you can start that, the sooner you can start generating income, the better. So let's say you take $10,000 and you put it in, you put $2,000 each in 5 different closed-end funds. Right now, they're yielding over 10%. Literally.
That's incredible. And that's a good yield. That's a really good yield.
Yeah. And they're doing, and you can get almost, right now, you get 10% in the ones that are investing in the stock market.
Yeah.
And the bond market. So you diversify. You got 10 of them. Everyone you owns hundreds of securities. So you're diversified out the wazoo. You know what I mean? You couldn't be any better diversified. So each time the income comes in, you add a little bit to one or the other. Whichever one is down a little bit, you add a little bit of the income to that one. And then the next deposit you make, either add another position or you add to ones that are down. If nothing's down, you buy a new position. You know, and that's the way you keep it. You build it. And eventually you'll find one that goes up. So the attitude of most people, these things trade like stocks, so they can think of them as stocks. Say, oh my God, this one's up 5%. And they get all excited and think it's so good and grand and wonderful. But instead, they got to say, hey, it's up 5%. You sell it, you take your profits, and now you have even more capital invested. And you keep doing that. So you have 2 streams of income. You have the distributions that they produce, and the gravy is the profits that you can take from now and then and then reinvest it.
That's beautiful. That covers that one bucket for sure, man, for the W-2 employees. Or would this still apply for just entrepreneurs? Those are in
for
business.
Entrepreneurs, if the business is successful.
Yeah.
And they're generating income, and it's not the type of income that I got to generate this much and I got to buy another store so that I can have another shop in this town and this town and this town. It's really one that you're making a lot of money and you need to think of things to do with it. And then you invest. You don't necessarily have to spend huge amounts of money investing in real estate. You do the same thing. You do the same types of securities, but with larger numbers.
Same with ETFs. Yeah, just larger numbers.
CEFs, ETFs. You can use ETFs. ETFs are growth, mostly interested in growth instead of income. And what I wanted to do when I got that portfolio that I got when I was 25, and I wanted to stop commuting to New York, and I built this income machine that it took 9 years. But wow. I more than doubled or tripled the money, and I was making 5 times my salary. And I said, okay,
from your funds, from your portfolio,
from my portfolio. So I could say, honey, I just quit my job. I'm going to start managing money for other people, and we're fine. We've got plenty of income to take care of things, which is almost literally what I said.
That's pretty awesome. Yeah.
And
now, I must have misheard earlier because I thought you said ETFs are the ones that produce income. It's a different fund that
ETFs do produce income, and some of them produce good income, but it's CEFs, closed-end funds. They're different. They're pass-through trusts.
Okay. I'm ignorant to that. Can you?
All right. A pass-through trust is something, let's say, you're wealthy and you want to leave money for your children or your grandchildren and stuff like that. You create a trust, and the trust is separately managed and it makes money, but you don't want to pay the taxes on it. The income gets passed through to the eventual recipient. So your grandchildren will have an account, and the trust puts the money in that account, and most of it's going to be taxed at a much lower rate than yours because so that's what a pass-through trust is.
Okay.
They have to give away 95% of the income, which is a nice position.
Now, is there any incentives for entrepreneurs? Is there a way? Because talk to me about the taxation of these too. Because it's
they're taxable. They're taxable. But let's say you do it that way. You put it into a trust, and you can then parcel off to family members. But I was that entrepreneur. I was growing a company. I kept growing my portfolios as well, my IRAs and this account. And after 40 years, I sold the business. When I sold the business, I got it was an offer you couldn't refuse. It was like 6 years income in advance.
Wow.
Well, that was the total. Of course, in the finance industry, they give you a little more than half up front, and then you got to jump through a bunch of hoops for the next 12 to 18 months.
Yeah, for an earnout. Yep.
To get the rest, you're not going into business in competition. All that baloney.
Yeah, right on.
So my portfolios were generating more than enough income than I needed to maintain my lifestyle without dipping into that initial payment they gave me. I didn't have to live off of that until I got the rest. I could just invest it.
That's incredible, man. That's awesome.
But that's, as an entrepreneur, geez, that's got to be your ultimate objective. What if you've got a real successful business and somebody comes on and wants to buy you out, and you've got an idea in your head for another business? That's where you want to be. You want to be, okay, I'm going to sell this to you. I've already got this income going. I'll add to it for a while, and I can use this money to fund that next business. Entrepreneurs are the perfect person to get interested in an income-focused investment. That they can actually live off that income. They have to.
That's incredible. So CEFs are great for income-based, and then ETFs are better, even though you can still make income off them. From what I'm hearing, ETFs are better for growth. They're
growth-focused. But you only really get growth in any instrument if you actually take the profit.
Yeah, that's a good point. That's a beautiful point.
People always say, "Oh my God, my account's up 40%. I'm wealthy," but a day like yesterday happens, or that happens for 2 months, like it did in COVID, or for 18 months, like it did in the Great Recession, and all of a sudden, you're not so wealthy anymore.
Yeah, no kidding. That's very true.
You can't retire yet, pal, because your 401k just dropped from $1.3 million to $750, and you just can't do it anymore. But if you've got an income portfolio, that's not affected by the stock market going down. That's not affected by interest rates going up. When you have an income portfolio, you can determine how to take advantage of the market cycle, whichever way it's going.
For sure. That just makes perfect sense, man. Yeah, exactly. Yeah. I love how your advice is really the same for both buckets of people. The difference that I see is that you mentioned, it's like, well, an entrepreneur could likely put more funds in. They can invest more. As long as the business is profitable. Exactly.
Right.
But what I really like is that this can be because there's entrepreneurs, but then I've talked for years about intrapreneurs, and I have a few. I'm the CEO of a public company, man, and I have a few intrapreneurs that are in the company, and they're absolutely irreplaceable because they treat the business as if it's their own, and they hustle as if it's their own. And at the same time, they just like the type of relationship to where there's a paycheck and a W-2, which is okay. That's perfectly great, but absolutely valuable. And those individuals, of course, they can be highly compensated, and then they have more disposable income, which means more they can put into a CEF and see that index grow over the years.
Yeah, it's not an index. It's a portfolio.
Okay.
It's a portfolio of stocks or a portfolio of bonds. It can be a portfolio of many different forms, or combinations of the two. They're totally. There's not as many of them as there are mutual funds or ETFs, but there's certainly the same mix of pretty much any type of investment you want to make. If you want an AI closed-end fund, they're there, and they're paying 8 and 10%.
I bet they are, for sure.
And that's mostly off of profits that they make internally, and they have to pass through to you.
Yeah.
But you could be in healthcare, you could be in energy, you want to be in all of the sectors.
That's incredible.
My portfolios contain about 250 different CEFs.
Yeah.
And another 20 or so ETFs.
Nice.
High yielding ETFs. But I own it's so diversified in every manner, from globally to different sectors,
Yeah.
that if something good happens anywhere, I'm going to be able to make some profits off it. And if anything bad happens anywhere, I'm going to be able to add to my positions at a lower price to generate more income.
That's
So
awesome. I see your book is Retirement Money Secrets.
Yeah.
And I mean, that's the goal of everyone. I mean, personally, I'll tell you this. I don't know if I believe in the word retirement, but I know a lot of people.
Well, hey, I'm 80 and I'm still working, right?
Yeah, well, right on. And it's because you love what you do, right?
Yeah,
and
it's just fun.
Yeah, it's a different story, right? I work with a lot of cool people and mentors in my life that once they've moved into that 60, 70-year-old decade, is they really transitioned into more mentorship roles. They absolutely love looking down, I mean, on guys like me to help them grow, because I mean, I think it was only 15, 16 years ago when I was broke with 2 newborn twins, no job, and started a business.
Wow. What is the nature of your business?
Yeah, it's cybersecurity.
Oh,
yep.
My grandson got started on that. He was interested. He took a lot of courses in it. And when he finally got a job, he managed to get this other job. It was an online job, and he took that instead.
Yeah.
And he did pretty well with that. So.
For sure.
Yeah.
It's done well for me, definitely. Was able to take the company public.
Should.
Yeah, for sure.
Wow.
But man, I appreciate you, and I think everybody needs to, I love your approach, because it's an approach that pretty much everybody can do. Like I'm a big fan of IULs because I have one, and I know how much it's going to grow and provide the income for me, when I'm 65 and beyond, to where I can borrow against the cash value, but the cash value I can borrow, it's, several hundred thousands of dollars a year and not affect the growth of the policy.
Right. I've heard of those programs.
Yeah, they're great for entrepreneurs where the business is making profits. They're fantastic for that. But yeah, I love your approach, because I love that you can actually do it no matter where you're at in your career, in your financial cycle, whatever it is. It applies to everybody. So, my man, as we bookend this, where can everybody find you to maybe buy your book or look you up?
Well, the book is everywhere. You can buy books. It's most of the sales are at Amazon, of course, and the Audible book is only available at Amazon.
Oh, great. Well, that's how I do it. I listen to audiobooks while I work out.
I know. In my generation, there was. That just didn't occur.
Well, there were books on tape, right? I remember those.
There was books on tape. Yeah, you have to plug it in the slot and
you sure would, like exactly. But it wasn't as convenient today. I couldn't work out while I'd be listening to a book on tape. Yeah, exactly.
This is real. And I'm surprised how many have sold that way. I mean, over 600. It's like 10% of the sales are on the audio.
Yeah, you got it. Well, Steve, I appreciate you coming on and giving us things that everybody can do to set ourselves up for income, not just for growth,
right?
For retirement. And everybody knows where to find you. So thanks again, my man.
Okay, my pleasure.